On board, Adrian Mowat as well. He represents JP Morgan. Adrian, hi, morning. How are you feeling about Indian equities? We've all seen the kind of weakness that we've gone through, testing the 5,200 mark, and of course the currency weakness as well. What's the call now on India?
Well, I think the call all goes back to the currency. If we look at the currency and we also look at the equity market, it is now statistically cheap, particularly within the equity market if you're looking at banks, materials and energy. And when we review the currency, it looks about 30% cheap versus its average real effective exchange rate. So there's definitely value there. The question, though, is can the RBI do enough to stem this type of rapid depreciation that we've seen in the rupee? And when you go back to the history of the Indian currency, this is the sharpest period of depreciation that we've ever experienced. And so reversing that is very important. And I think what was done yesterday with regards to the use of swap lines is constructive in helping that. But ultimately, I think the most important thing to do is to look at what's happening with the trade balance and the current account deficit. Now, the government estimates that they would like a deficit of 70 billion. We think it's probably more realistic to be 80 to 90 billion. However, when we look at trade data at the moment, it is suggesting that the current account deficit is narrowing quite quickly, and maybe a run rate of near a sort of 30 billion is being implied by the data, and that is obviously quite encouraging.
Adrian, as someone who's been monitoring India quite closely, although sitting outside, what do you think the RBI can do? Because part of the market also believes that this is not an India-related problem, but more to do with emerging market currencies. We've seen that happening in Turkey, Indonesia, and India is no different.
Yeah, but the RBI is doing exactly what they should do, which is allow the currency to depreciate. This makes them different from Indonesia, which has tried to protect particular levels on the currency. Your currency depreciates, your import bill will go down, your export bill will go up, and that's how you solve it. You let the markets do the work. So broadly, the RBI is doing the right thing.
Adrian, in the current environment, I guess it's very easy to make a bearish scenario for Indian equities. Rupee is the pain point, economic recovery will get delayed, earnings are unlikely to grow. But do you think all the bad news is in the price? Because the way markets operate is that they always tend to focus on future, never focus on the past.
Yes, look, as I said already, there are certain sectors in the Indian market that are looking statistically cheap. The currency looks cheap, so there clearly is value here. But value is not a catalyst for purchase of markets. What you need is confidence that the pace of rupee depreciation is going to slow. And, there is an argument with what happened yesterday that the RBI is coming up with measures that are more effective in that. This is a game of confidence. The currency is already oversold. The question is, how do you stem the direction as opposed to sort of the underlying fundamentals and value?
Adrian, Indian markets are extremely dependent on global flows. Now, the data in last 10 days, if I look at the FI data, is indicating that foreigners are now in a mood to reduce their exposure to India. Is that a big concern? Because India is still a very overowned market, and nearly 20% of Indian markets is owned by, foreign investors.
Okay, well, let's think about that question, right? If we were in an environment where foreigners were buying, would we extrapolate the market constantly going up? I think the problem in this focus on flow data is flows actually tend to follow rather than lead market moves. You are correct that foreign investors are a significant part of this market. It doesn't make India unique. That is true for all markets. In the case of China, the 8-share market is 100% owned by foreigners. There's no local participation in that. So the issue here is that the fundamentals and particularly the confidence around the currency. So if we can get some stability on the currency, then I think flows will reverse and the Indian equities will begin to rise once more. But they'll be led by the sectors that got punished the most in the sell-off. So it is going to be things like materials and banks, rather than consumer staples and the IT names, which still are good value, but they're not going to be the leaders in the market when the currency stabilizes.
Adrian, when you say banks, would you stick to the private banking lot, or do you find value now in some of the PSUs as well? Because some of the valuations are looking mouth-watering.
Okay, I mean, I can't specifically talk about stocks, but if you look at this generically, I would be taking money out of the higher quality private sector banks that have held up better. Would still be buying some of the private sector banks that maybe are more wholesale funded, so suffered in the decline, and also would look at some of the PSU banks, which are looking statistically very cheap. So it's sort of slightly lower quality, a little bit more PSU than private sector than people have been holding up till now.
Adrian, in the month of August, consumer staple stocks have also reversed. In fact, the BSE FMCG index is down by about 15% in last 1 month. Do you think staples could correct some more because they are still expensive?
Well, I think there's a degree of that, but it's an interesting point you bring up. We've begun to see in the last couple of weeks the sell down of high quality names. This suggests a degree of capitulation going on in the market, and that often marks that we're closer to the lows. So I would suggest it's a good sign. But if this is a story, and this is a very big if, that the currency can stabilize around this level, maybe the sort of 66 to 68 range, maintain that for a few weeks, then I think it's going to be the sectors that have sold off the most in the last couple of months that probably do the best. It's interesting when you look at some of the material names, some of the steel companies, they clearly are winning domestic orders through import substitution. And it's often import substitution that's the first thing you see after currency weakness.